Outside of Tesla, Apple was the other big tech that came into earnings season with extremely low expectations, and when you post a Q2 report that is just slightly better than feared, yeah, you'll see a pop in your shares after hours, and that's exactly what we saw with Tesla, and that's exactly what we're seeing with Apple, as you have shares higher by close to 7% in the after hours on the report of their Q2 print, which came out after the bell. We'll go over the headline numbers. We'll also go over the announcement of a dividend bump up and the announcement of a new $110 billion share repurchase program, Apple doubling down on themselves really and buying back their stock. We'll also take a look at their segment results by category and by geography. We'll see how iPhone sales coming in weaker than expected, but you have, like a broken record, the services business over at Apple continuing to just hold it together and keep things good. We'll also take a look at the regulatory news over at Apple. This one, I think, really keeping a lid on this stock to some extent, and probably the biggest bear case in my opinion is from a regulatory perspective over at Apple. We'll jump into all the financials, and then as always take a look at the technicals. Hello breakout, as you have shares rocketing close to $184, breaking out of this downtrend for, call it, the past 4 to 5 months. We'll see where shares of Apple are likely headed, and spoiler alert, it is probably closer to your all-time highs. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Shares of Apple, despite gaining 2.2% in the regular trade, you have shares higher by close to 7% in the after hours, making up for a lot of those year-to-date losses of close to 10%. And so you have this company flat over the past 1 year, and tomorrow likely will be up, call it 6 to 7% if these gains hold in the after hours. And so you have that market cap still sitting north of $2.6 trillion. And from a forward valuation perspective, trading closer to 25, 26 times an earnings multiple. Certainly not wildly expensive, but when we look at the growth rates, or pardon me, the declining growth rates over at Apple, we'll see that valuation still can be considered slightly expensive for the stock, considering you have revenues coming in at $90.8 billion. Yeah, for me and you, that number would be fantastic. But for Apple, that is actually down 4.3% year over year. Did beat estimates on Wall Street by close to $190 million. Like we said, the expectations coming into this print were really at the floor, and when you come in just slightly higher than that compared to estimates, yeah, you will have a nice reaction in your shares. On top of that, Apple coming in higher on their EPS, as that came in at $1.53. Estimates on Wall Street were closer to $1.51, which would have represented roughly 1% declining EPS year over year. Apple coming in with those strong buybacks, sort of financially engineering their EPS, came in with a flat EPS figure year over year. As we look ahead to the next few quarters, you see starting in Q3, which is basically the current quarter we're in, Apple expected to accelerate their earnings per share every quarter, call it until Q3 of 2025. You see growth is expected to go from 4% to 5%, 5.5%, then up to 9%, and then all the way up to 11.2% by the time we get to Q3 of 2025. Similar story on their revenues. We saw that declining close to 4% year over year in this most recent quarter, but as we look ahead, you have accelerating revenues, although be it a small number, but you have revenues going from 1.3% growth year over year up to 3%, and then 4% all the way, call it up to 8.5% by Q3 of next year. So really, did you have the bottoming out in the revenues and earnings, at least from a growth perspective, in this most recent quarter, as the expectations on Wall Street are for modest growth that is accelerating, call it over the next 4 to 5 quarters. And then on top of that, when you have an additional $110 billion share repurchase or otherwise a buyback authorized, yeah, that will probably help your EPS grow at a faster clip as well. So probably having that into account will bolster up your EPS over the next couple of quarters, and so analysts will likely have to adjust that in. You also got a small 4% bump up in your cash dividend, now up to 25 cents per share. That is on a quarterly basis, so you're looking at basically exactly $1 per share on a full year adjusted basis. Not a huge bump up in their dividend, and likely I'd say a large reason because Apple just wanted to continue their streak of 12 consecutive years of dividend increases. They gave us that 1 cent per share increase on a quarterly basis. So not a huge deal, that dividend increase, certainly not game changing over at Apple. I'd say the authorization of this $110 billion buyback, far more important. And when we get over to their cash flows, we'll see this $110 billion to me and you is, yeah, more money than we know what to do with. But for Apple, probably a figure they'll go through, call it, over the next 2 years in terms of completing their buyback. Now, in terms of net sales by category, we also saw slowdowns in a number of different categories. Obviously, we saw a slowdown in the iPhone sales, really still the bread and butter for this business, as you have revenues coming in at $46 billion flat on your iPhone side. Last year in the same quarter, we were sitting at close to $51.3 billion. So basically a $5 billion slowdown on your iPhone sales. You look over the last 6 months and you have a similar story where you have a slowdown in your sales, not nearly as large as you got one in this quarter. Now, on top of that, you had your iPad business basically fall off a cliff, down 17% year over year, down to $5.5 billion last year. You were closer to 6.6. Similar story on your 6-month basis, as you have iPad revenues really tanking, and a lot of this reason is probably likely due to the fact that Apple expected to release a new product next week, and a lot of people are anticipating an iPad refresh cycle. So you probably have a number of customers just holding out on picking up the iPads, considering they're expected to have a new refresh cycle coming later this year. And so I think that's one reason. The other reason for the slowdown in the iPads is probably, frankly, due to the fact that these products are so robust, so good, that you just simply don't need to replace your iPad every year, every 2 years. Probably can hold on to it for, I'd say, 4 to 5 years, in fact. And so just the extended timeline on your refresh cycles probably contributing to your lower iPad sales. We'll see. Hopefully this ticks up as we move on later in the year due to that iPad refresh cycle. You also got a slowdown, roughly 10% on your wearables, now coming down to $7.9 billion. Last year, you were at $8.75 billion. Similar story on your 6 months, having a slowdown on your wearables business. So Apple not really having innovated on their wearables. The AirPods are basically the same as you had a couple of years ago. The watch, they did come out with that Apple Watch Ultra, but other than that, the watches pretty much seem to work the same as they used to before. So I think the lack of innovation on their wearable side certainly showing up in their financials. Now, you still have the one bright spot over at Apple, and that is the services business, as you had revenues go up to $23.8 billion. Last year, we were sitting at $20.9 billion. Similar story on a 6-month basis. You have revenues nearly topping $47 billion. Last year, they were at 41.6. And so the services business continuing to just chug along, continuing to grow, call it at a 14% clip, and helping out the growth rates over at Apple. Despite your overall revenues coming down $4 billion, declining 4%, you still had tremendous growth on your services. And keep in mind, this is a higher margin business over at Apple. In fact, when we take a look at their operating expenses on this side, we'll see the gross margins, in fact, got even a whole lot better. So the services still continuing to be a bright spot over at Apple. I'd say this is still remaining the bull case over at Apple. If you believe that this 26 times forward price to earnings multiple, certainly not expensive over at Apple, if maybe it is fairly valued, I think the fact that you have a nearly 14% bump up in your services revenue, again, a higher margin business, that is the bull case you're making over at Apple. In terms of the sales based on geography, you saw a basically flattening out in the North America segment, as you have revenues, again, year over year, slightly down to basically flat. Similar story on your 6 months. You have the revenues just marginally up, $700 million. Again, to me and you is a life-changing amount of money, but to Apple, basically a rounding error. Now, Europe, you did see pretty strong demand over in Europe, coming in at $24.1 billion. Last year, you were at 23.9. Similar story over the 6 months. You have close to a $3 billion bump up in your Europe sales. Now, the all-important Greater China, look, we have a ton of companies we've covered, Nike, Tesla, and now Apple. They all do business, and a large part of their business in China. And what we've seen from all these other companies is that business in China is slowing down, and Apple is not immune to that, as you have sales coming in at $16.4 billion. Last year, you were at 17.8. And so you had an 8% slowdown year over year in that China region. A lot of that is likely just the fact due to you have a lot of competition from Huawei in the smartphone market over in China. You see this with Tesla, as they're having to compete with those Chinese EV makers. And we're seeing that with Apple, as they're having to compete with the Chinese smartphone maker. And similar story on your 6 months, you had revenues come down to $37 billion. Last year on a 6-month basis, you were at 41.7. So China continuing to experience slowdown. At some point, you're hoping to see this one at least flatten out from a growth perspective, but you have Apple losing market share over in China for really a long time. And so if that trend continues, certainly not a promising sign. The other thing I do want to mention while we're on the subject of China is you have the TikTok ban going through the US government right now, and the one country that really isn't happy with that is China. And I've heard stories where they may look to retaliate against North American companies, and probably the largest company they could look to retaliate against is a company like Apple. And so if certainly that TikTok ban goes sour with the Chinese government, yeah, they can certainly look to put some sanctions or at least some barriers in effect to really, really cripple Apple's sales in China. And so if that does materialize, that will certainly be a huge blow to Apple's top line, probably one that isn't factored into the valuation at this point. Now, you did also have slowdown in Japan as you had sales come down to 6.3. Last year, you were at 7.1. And then also similarly, large slowdowns in the rest of APAC, where you had sales come to 6.7 billion last year. You were at 8.1. So really across the board, you had slowdown in revenues. Europe was the one bright spot, and then a flattening out of revenues in North America. Likely that iPhone 16 refresh cycle is what a lot of people are waiting for, and certainly if that new iPhone 16 doesn't deliver, that will be very disappointing for Apple. Certainly probably, again, part of a big bear case if that iPhone 16 certainly does disappoint. Now, speaking of bear case, probably in my opinion, the biggest bear case over at Apple is the fact that you have the DOJ absolutely cracking down on this company for a lot of different reasons. And one of those reasons being that the Google having monopolized the search and advertising business by being the default search engine on Safari and allegedly had paid Apple $20 billion. This was a figure in 2022. So if I was to assume in 2024, that number is probably closer to $25 billion, considering that we still know Google is the default search engine on the Apple devices. And considering Apple has that install base of close to 2.2 billion units or 2.2 billion devices, it certainly is in Google's best interest to continue to be the default search engine on Apple. But certainly if you have the DOJ cracking down on both of these companies, not just Apple, yeah, that will probably likely hurt both of them significantly. And consider the fact that the payment that Google does to Apple formed roughly 18% of Apple's operating income in 2020. And in my opinion, again, I'd say that number is probably higher today than it was 4 years ago. And if you have nearly 18%, if not higher, of your operating income in jeopardy due to the fact that the DOJ is really cracking down on antitrust, anti-monopoly behaviors, yeah, if this really goes to fruition and a lot of the antitrust lawsuits against Apple result in them having to change their business and really open up their ecosystem, I think that is a huge bear case. Again, likely not priced into the stock at this point, but largely I'd say the largest bear case considering how sweet that nearly $20 billion top line figure is to Apple's bottom line. Now, as we saw, you had a 4% slowdown in your net sales coming down to $90.7 billion. Again, your services business still growing at 14%, and so that just speaks volumes to how much their products business, or the iPhones, the Macs, the iPads, are really weighing on this business when you still have the services growing at 14%, but your net sales dropping close to 4%. Similar story on your 6-month basis. You are down on your sales, not nearly as large, right around a $1.6 billion decline on your net sales. And for a company posting $210 billion in sales over just 6 months, certainly not a huge decline, but you have essentially flattening out of those revenues. But what you do have with this company is a tremendous control on those cost of sales. And so you'll have a lot of bears point to the numbers that the net sales are declining year over year, are basically flat year over year. But you also will have them not talk about that the cost of those sales are also declining, or at least also being controlled extremely efficiently. And so you had your products go down by roughly $7 billion on that top line, and then you controlled the cost of that by close to $4.3 billion. In terms of your services side, despite your growing your revenues close to 14%, you actually didn't budge at all on the cost of those services. And so you had your gross margins actually go up to $42.2 billion. Last year, you were on $41.9 billion. So despite lower revenues by roughly $4 billion, you were actually able to generate an additional, call it $300 million on your gross margin. So extremely efficient from at least the cost of those sales. On the operating side, you were able to control your costs not nearly as efficiently as the cost of sales, but certainly not expanding rapidly, as you had R&D tick up to $7.9 billion last year. You were at 7.4. On your SG&A coming up to 6.46. Last year, you were at $6.2 billion. So not huge tick ups on the operating side, and so that leads your operating expenses to come in right around $14.4 billion. Last year we were at 13.6, and so despite growing your gross margins by close to $300 million, you did generate an additional $600 million in terms of operating expenses, and so that will lead your net income to decline by close to, call it $300 to $400 million. Not a huge decline year over year, but again, that net income declining, showing that this company really doesn't have too many levers to pull on the operating side. And so when their sales are declining, yeah, because a lot of their operating expenses are now fixed, they simply don't have the ability to continue to expand their net income. What they do still have the ability to do is expand EPS. As you saw, EPS come in flat year over year despite lower net income, and a lot of that is due to the share repurchase program Apple has in place, and they're reducing their shares outstanding, bolstering up their EPS. So certainly on the EPS side, you have some positives, but net income declining, showing underlying weakness in the actual business. In terms of Apple's balance sheet, this is an area probably not as good as you have other balance sheets on Wall Street. Certainly a Meta, Google, even Amazon probably have better balance sheets, simply because Apple is a company that does tend to carry on quite a ton of debt, as you have close to $10.7 billion in short-term debt and an additional $91.8 billion in long-term debt. You do see that debt tick down year over year, at least on that long-term debt side. Some of that did get translated to your short-term debt, but Apple coming in and repaying some of that long-term debt. That is balanced out by, call it, close to $32.6 billion in cash and cash equivalents, another 34.5 in marketable securities. And so you do still have more total current assets just by a little bit than your total current liabilities. The other important number on Apple's balance sheet is certainly the inventories figure. This number, at least on a 6-month basis, not jumping too much year over year, in fact declining. You did have that holiday quarter sandwiched in between the September and March period, and so some of that inventory decline likely due to the fact that you have that holiday period in between. The other important thing to notice is the fact that your property, plant, and equipment over at Apple not ticking up, in fact actually ticking down over the last 6 months, down to 43.5. Last year you were at $43.7 billion. So what we see with a lot of other mega cap companies like a Microsoft, Amazon, Meta, Google, you have a bump up in your property, plant, and equipment because these companies continue to invest heavily in building out their AI infrastructure. And that's exactly what you don't see with Apple, as you have actually a slowdown in your property, plant, and equipment. Certainly, if this company in the coming years shows that it's lacking on AI innovation and AI infrastructure, we can come back here to this property, plant line and see that Apple simply just wasn't investing heavily enough into their AI infrastructure. All things considered, though, from a balance sheet perspective, you have a still pretty solid balance sheet, tons of cash. You also still, despite nearly $91 billion in term debt, long-term debt, you see this company not paying a whole lot in interest expense. In fact, when we look at their other income, this is the line that should highlight your interest expenses, and you see it is actually positive. So Apple, despite holding nearly $100 billion of debt, is probably earning more interest on that debt than they are paying on it. Certainly the rates Apple gets on their long-term debt, yeah, that's not the rates that me and you get. And so from that perspective, Apple not paying off this debt really rapidly, again, not something I would be overly concerned about, just because the interest rates they're paying on that is frankly very, very small. Now we see operating cash flows. This is over the last 6 months, as we have a 6-month period coming in at $62.5 billion. You see year over year basically flat, almost a rounding error over at Apple. So they're not able to expand operating cash flows. And as we saw, this company not investing heavily in property, plant, and equipment. You see CapEx for this most recent 6 months coming in at $4.4 billion. We see companies like Microsoft, Google, Amazon spending tens of billions of dollars a quarter on the acquisition of property, plant, equipment. Apple coming in with just $4.3 billion of CapEx over the last 6 months, and that is actually slowed down on a year-over-year basis. So you have last year property, plant, equipment CapEx coming in at $6.7 billion. Now that's at 4.4. So again, like we said, Apple certainly not investing heavily in their AI infrastructures. If they do have a long-term play, we'll have to wait and find out for that. But certainly if they get lapped by the likes of Microsoft, Google, even Meta, yeah, it's pretty obvious where that fell through over at Apple. And now the majority of their operating cash flows goes to the form of buybacks on their common stock. As you see, they purchased close to $43.3 billion worth of their common stock over the last 6 months. Again, that is an acceleration where we were last year. And so when they say they announce an increase of $110 billion to their buyback for a company that's spending, call it $90 to $100 billion annualized on their buyback, yeah, this $110 billion will evaporate pretty rapidly over at Apple. That's looking at roughly a 1 to 2 year timeline on their buyback. And so that will certainly put a floor on the stock, as you have Apple being the biggest buyer of their own shares. They'd also do pay back some of their long-term debt, a little bit of their short-term debt, all things considered, and then you do have a small dividend increase year over year. So all things considered, a lot of that operating cash flows is not actually going back into the business. It's flowing to you in the form of buybacks. And certainly Apple is not the growth company it once used to be, and if you are holding for that, that's likely what you're not going to be getting from Apple moving forward. Now, despite Apple not being a growth company moving forward, doesn't mean you still can't make money in the stock, as you have shares rallying close to 6.5% in the after hours, coming up to $184, basically on the nose. And so when you have expectations essentially on the floor for their Q2 and Apple comes in slightly higher both on that revenue and EPS side, yeah, they will see a pop in their shares. And speaking of pop, you also broke through a downtrend that was pretty prominent, call it over the last 4 to 5 months, where shares of Apple were seeing a consistent pattern of lower highs and lower lows. This decisive breakup, certainly if it does hold tomorrow, will confirm a breakout over this pattern, as you have shares of Apple trading higher than their previous set of highs. I'd say the next level of resistance over at Apple is probably at your all-time highs, close to $200 a share. That's probably the next level where Apple will come in and retest. Certainly wouldn't happen in a straight line, and so I would expect shares of Apple at some point to pull back into this range of, call it somewhere in the 170s to $180 a share. At that point, that pullback might be the start of a new uptrend. Certainly if it gets validated at that point and continues to head higher, that could be the start of a new uptrend for this stock. Certainly if it can come up here over all-time highs and then blow past them, yeah, this company will likely have some room to run. Certainly from a valuation perspective, probably not a whole lot of room to expand their earnings multiple, at least while their earnings are only expected to grow somewhere in that, call it mid-single digits for this year and probably for next year. But you still have a decisive breakout from the lower highs and lower lows trend over at Apple. And so likely if you can have a validation back to some sort of a trend line, that could be the start of a new uptrend over at Apple. Certainly not one I would be looking to trade in and out of, and despite not seeing that explosive growth in Apple anymore, you probably do have a level of floor on these shares, just simply based on the huge buyback that Apple does themselves. That was my take on shares of Apple. Let me know your thoughts on this one in the comment section below. We'll see what Apple announces next week on their new product launch, and we'll take a look at what Apple announces on their upcoming iPhone 16, see if there's really some AI capabilities present in that and if that spurs demand. Hope you enjoyed this video. Thanks so much for listening, and I'll catch you guys in the next one.